impact investing in health, from mission to capital allocation. We have a program for you today for this hour that involves many speakers and panelists. You'll learn from Amplify Capital, Cross-Border Impact Ventures, and the Terry Fox Foundations, and we hope that you'll learn about impact investing as well. Before I welcome the first speaker, just wanted to say that we have live interpretation. If you're attending this meeting and would like it in French, just activate the button. There's a language interpretation available. Alors, bonjour tout le monde. Merci de vous joindre à nous pour ce webinaire aujourd'hui. Si vous souhaitez obtenir une traduction de l'anglais vers le français en direct, on vous invite à sélectionner la traduction avec le petit bouton qui est disponible. On a ça pour vous aujourd'hui. To kick us off, before I come back and I share about the formal program, I would like to welcome Miles Surgeon for a few words. Dr. Miles Surgeon, would you like to take the floor?
Sure. Thank you very much. I am like a little kid this week, excited about the astronauts, pretending to be an astronaut today, but I am a family physician. I'm a family physician in Hamilton. I work both in the hospital setting at Hamilton Health Sciences and in the community. And I am the executive director of the Canadian Coalition for Green Healthcare, which has been around for 26 years. It's my role in the coalition to think about what are the biggest opportunities to decrease the carbon footprint of the healthcare system. The healthcare system in Canada is 5% of the national footprint, which is actually more than the airline industry. So there's a lot to be done. And you may be surprised to know that the big items are not the boiler room, not LED lights, and not EV chargers. The big items are supply chain, all the things that we buy as a hospital system, and investments. And so that's why we're here today. I became aware of this a few years ago because I am an academic based out of McMaster. And as you may know, the students went on strike a few years ago. It's a long story, but McMaster's investments bumped from about maybe 0.98 in fossil fuels to over 1%. And that initiated a hunger strike by some of the students. Interestingly, at that time, McMaster was rated #1 of all the med school universities in the country in terms of the reduction in fossil fuels. Since that time, McGill has completely divested. McMaster still sits a little less than 1%. Toronto, UBC, a lot of the big medical school universities have moved away from fossil fuels. So I was just curious why these sister hospital organizations had not started to do this, and reached out to Trache Foundation to see if they would help fund this project, and they did. We're very grateful for that. And of course, we also work with Quinn and Partners for the expertise. So 20 years ago, I think most hospital foundations probably moved away from cigarettes. Have we moved away from weapons? Have we moved away from fossil fuels? If we think about, in my view, a hospital foundation, we should be doing things which are healthy for the community. Maybe that's idealistic, but that's my view of the world. Burning fossil fuels, the burning of fossil fuels represents about 70% of greenhouse gases in the planet. Most of it comes from the burning of fossil fuels. And of course, climate change is bad for health. I've got a whole lecture on that if you want to hear more. Burning of fossil fuels not only warming the planet and creating various disasters, but also directly bad for our lung health and heart health, etc. So we are organizing a few educational sessions about what is healthy capital. Again, this is a 2-year program. We're supporting Canadian hospital and healthcare foundations to learn more about sustainable investments. And the session today is to, 1, demystify impact investing, to equip the audience with a practical understanding of impact investing and the possibilities it offers to align their investment with the mission, and to explain where impact investing fits in a foundation's asset allocation, how to think about risk, return, impact, trade-offs, and what good looks like. And Rosalie, I'm going to pass it back to you. Thank you.
Thank you, Miles, for these opening words. It's indeed a session on impact investing, as Miles was saying, specifically for healthcare foundations leaders. And we're very grateful that a lot of you are tuning in. We had close to 80 registration from the sector. And if I can go to the next slide, I'd like to share the program for today. As Miles was saying, we'd like this webinar to be educative to demystify impact investing. So we'll take a few minutes to learn more about what it is with an impact investing experts. And then we'll move to experienced panelists who will share their experience, their story. So we have representatives from asset owners and asset managers who will come in and help us understand with practical examples. We have set aside some time for Q&A, so I invite you right away to prepare questions that you can share in the chat in the Q&A portion that you can see the button at the very end, and I'll remind you of those. But I think probably by now you might be wondering what is impact investing. So we're going to put it out there right away at the beginning. It's an investment made with the intention to generate measurable social and environmental impact alongside financial return. So I've thrown in lots of words here. And maybe the first thing to say is all investments have positive and negative impacts, whether you'd like it or not. And so what it is about here is, and what I'd like you to do as a participant is think about how capital of foundations are aligned with the mission. So we know that we're often talking about the procurement of assets of financial return to generate donation. So that's great. I'm talking about the rest, the capital that stays and is not donated. How is it aligned with the social and or environmental mission of the foundation that you're all leading? We believe there's a real opportunity out here to align further and obtain positive outcome. And to learn about that, I'd like to invite my colleague, Jason Sukram, to tell us more about that. Jason is a director and leads Quinn and Partners Impact Practice. His expertise lies in developing strategies to intentionally improve outcome for people and the planet while generating financial return. Prior to joining Quinn and Partners, Jason led the impact measurement and management practice at the Mars Discovery District Center for Impact Investing, and he also worked with the Clinton Foundation's Poverty Alleviation Social Enterprise Initiative from New York and Colombia. Jason, can I invite you to take the floor?
Absolutely. Thank you so much, Rosalie. And thank you to everyone for taking the time to join in the panel today. Appreciate the introduction and to the Canadian Coalition for Green Healthcare for having this space for this conversation about impact investing. For those who have been a part of the organization's initiatives and all of the hospital foundations that have been working to advance their sustainable investing practices, it's exciting to have this opportunity to talk a little bit more about how impact investing is driving health outcomes. So I'll just be spending the next 10 minutes talking a little bit about impact investing and providing that context. Just want to get a thumbs up that you can see some of the slides that I'll be using to perform. Okay, great. So as Rosalie and Miles both introduced the topic at the top of this webinar, they also introduced the idea of the tremendous amount of need. And this is one of the drivers for this idea that our capital that is invested or held within our foundations has the potential to be transformative for social and environmental outcomes globally. For those of you that are familiar with the United Nations Sustainable Development Goals, you may know that there's an estimate that almost $4 trillion will be required every year to be invested or to be leveraged by public and private sources to be able to address and meet those goals related to poverty, related to access to healthy food, education, and of course, to address the climate crisis. So there's a massive gap in the amount of money that we need to address those. At the same time, while the impact investing space has been growing, it's now over $1.5 trillion managed annually for this purpose, and growing at over a 20% annual rate. It's not enough. There's a massive gap. There's more funding that's required. And there's also an increasing awareness and increasing consciousness by more people who are starting to see where their investment capital is managed, and they're asking questions about how can we be moving our capital to do more that will have that positive social and environmental impact that Rosalie mentioned. As we know, all investments have both unintended and intentional positive and negative social and environmental impact. So we're in the midst of an intergenerational wealth transfer where more people are now getting control or influence over their capital, and a great proportion of them want to see that capital managed for these purposes. In the Canadian context, we also know that there's over $120 billion sitting in Canadian foundations endowments. And most of these investments, as Rosalie was mentioning, is not managed for any particular purpose or any particular social or environmental objective. So while the foundations may have philanthropic objectives to address health challenges or environmental challenges, their money is not being managed for that purpose. So there's a tremendous opportunity there. So you may have seen a version of this diagram in many other places, but to illustrate the point of what impact investing is and where it sits into this spectrum of investment approaches, wanted to highlight how each of these investment approaches sort of differ. And this will help sort of underline how impact investing is meant to achieve a specific outcome. So at the top, you'll see sustainable investing. Sometimes you'll see this referred to as responsible investing, but within this spectrum of approaches, there are different investment strategies that are meant to increasingly address social and environmental factors. So starting with ESG integration, looking at how social and environmental factors will have a financially material impact on your business. So how do you look at climate change or rising sea levels or labor and human rights risks and data privacy risks? How can these materially impact your company's bottom line, and how should you be managing for these while you're also trying to deliver competitive financial returns? Then you move into negative screening and thematic investing, which is starting to look at certain areas where your investment capital can go and taking out things that you don't want your capital to be contributing to. And there are many of these themes. Miles was referring to tobacco at the beginning, and then moving it into areas where you want to see more of a specific focus, like healthcare, health technology, maybe education, maybe climate, and certainly renewables and clean energy. What the difference is for impact investing is not only are you intentionally moving your capital towards these specific thematic areas, but you're actually measurably working to improve the impact performance alongside generating a specific target financial return. So there is this intentional and there's this effort that goes on top of investing in these areas to make sure that the outcomes that you're trying to generate are being achieved and that you're changing your investment strategy or adapting it as necessary to not only improve the return of your portfolio, but to also increase the efficacy of that capital in solving those social and environmental challenges. On the far right of the spectrum, you see impact first philanthropy. You may have heard that, to be an impact investor, you have to trade off returns. And there's more than enough evidence. We won't get into all of it today, and I know our panelists will talk about this quite a bit. But there is also an area where some investors are saying, okay, well, we want to prioritize generating outcomes, and maybe we will use different forms of capital that will accept a lower rate of return. And that looks closer to philanthropy than it does to investing, but it doesn't mean that all impact investing needs to trade off financial returns to achieve its objectives. So, on that note, to further emphasize how impact investing differentiates from those other investment approaches, what we found is that there's really four key principles. And the first is, as we said, an intention to generate positive, measurable social and environmental impact alongside the financial return. That intention is the first and most important principle. There is an explicit objective embedded into your investment strategy. There is policies, there are frameworks that you're using that says we will make investments on this basis to improve health outcomes in this specific area or in this geography, or to help progress along the United Nations Sustainable Development Goals. That intentionality is a foundational principle of impact investing. Second, as I mentioned before, an effort to make sure you're measuring, managing, and reporting on that impact performance and being and holding yourself as an investor accountable for how well you're achieving those objectives. On the financial return perspective, As I mentioned, some impact investors may have a below market rate return expectation, a concessionary return, but now there's more than enough evidence that having an impact investing strategy will also allow you to reach adjusted market, risk adjusted market rate return expectations, and especially across different asset classes. Also, in impact investing, you may have heard the term additionality, which is what else can an investor do, whether it's an engagement or stewardship or technical assistance to support the companies that they invest in to achieve those financial returns and those impact objectives. So quickly, in the current context of our world, of course, we know that there's headwinds. People are looking at whether impact investing is still a priority in today's market. And this is just to say that, the growth of the impact investing market, it has been steady. Looking at, 21% compound annual growth rate over the last 6 years and then over 10% in the last year, we're seeing more capital continuing to move into this market. And on that turn of returns, one thing that we know the panelists will speak about is that we're also seeing higher correlation between businesses that have high impact materiality. That is, that their business actually drives a specific social and environmental impact that is generating statistically significant excess returns. So what investors are starting to see is that not only does doing impact help them achieve certain objectives, but it's also helping them satisfy their financial and fiduciary responsibilities as well. So before I hand it back to the panel, I wanted to share a little bit about what we're seeing in Canada and globally around how impact investing is showing up for foundations. So as Rosalie mentioned, historically, and what the current state for many foundations is that if you look at this bar chart on the left side, most of the endowment, that long gray bar, is investments that are sitting in traditional assets, traditional investment managers, where there's no consideration for any social environmental impact. And then around 5% of that every year is donated to achieve some philanthropic objective. Over time, and what we're seeing more of, is that endowment is now being used for different purposes. There's a portion that's now being managed for responsible investment. There's a portion that's now being used for impact investments to achieve philanthropic purposes. And the grant portfolio is getting larger when catalytic finance and other forms of finance are being used to, again, achieve the philanthropic objectives of the organization. 3 examples here. InSpirit has had a 100% impact portfolio for several years, $35 million endowment, and is outperforming its benchmark by 9%. The $1 billion family office out of the US Builders Vision is planning to transition 90% of its assets into impact investment that are aligned with its philanthropic objectives, showing that there's a demand for more capital to go here into impact. And similarly, for the McConnell Foundation, the same thing. One of Canada's largest and leading impact investors is planning to translate or transfer its entire endowment over 700 million into impact investments across asset classes. So that bar on the right is going to look a lot less gray in the future. So for those of you listening in, this is my last slide, just to think about what it might look like to get started. You'll hear from the panelists some examples of really powerful investment strategies to now drive capital towards positive health outcomes in cancer research, in global markets, in innovative technologies, even here in Canada. And for you as a foundation, if you're listening to this or thinking about what it would take to bring your foundation along in this journey, here's a little bit of a journey. Maybe starting with those that are within your organization, building their knowledge and capacity around what this is, helping to understand how it aligns with their fiduciary duties, then moving into building policies, bringing your governance structures in, and starting to build in the tools that it would look like to how do you assess impact investment opportunities. Eventually, you can start experimenting on how to use your capital with different investment managers. And before you know it, you'll be actively deploying capital to achieve both your philanthropic and your financial objectives. So with that, thank you for the opportunity to provide this overview on what impact investing is and what it means here for your foundations. And I'll pass it back to Rosalie, who will take things into the panel conversation.
Thank you, Jason. That was informative. We'll be able to share the material of this webinar after for those of you who are interested. So to illustrate what Jason has been talking about, to illustrate impact investing, some of the drivers, the challenges, talk about the results, I'd like to welcome 3 esteemed panelists to the floor, practitioners that are both from what we call the sell side by side. So the two ends of the investments, those providing the capital and those using the capital to invest it in various projects and companies. So you see their name. I'll introduce them and then we'll get started. Catherine is managing partner and leads Amplify Capital. That's a leading impact fund in North America. Authentic impact venture investment platform. She founded and led Social Venture Partners Toronto from 2007 in 2012. And she also led the Mars Catalyst Fund in 2015. That was a Mars and Virgin Unite collaboration to launch an early stage impact fund in Canada in 2016. And she's got 25 years of career in investing and managing venture capital. So welcome, Catherine. Alongside Donna Parr is managing partner at Cross-Border Impact Venture. So it's a dual market venture return impact fund focused on commercializing disruptive medical technologies for women's and children's health. So Donna has over 30 years of experience in venture and private equity investing and prior experience in corporate finance. She's also active in a startup that has developed a patent medical device for cardiovascular disease. Welcome, Donna. And finally, we have Michael Madza. Michael is the executive director of the Terry Fox Foundation and has over 25 years of leadership experience within healthcare non-for-profit organizations. Prior to leading the Terry Fox Foundation, Michael has held leadership roles at organizations that include the Canadian Cancer Society, the Scarborough Health Network Foundation, and the Renaissance Foundation. And also has extensive experience in non-for-profit governance, strategy, and fundraising. So welcome, Michael. I'd like to get us started. So hopefully the participants will see us all in sort of a gallery mode. So I'd like to welcome you all and ask you to start explaining to us why those specific health problem, health outcomes, health opportunity push you to take action, and why you created the funds or oriented some of your funds towards that specific topic. So woman first, I'll start with you, Catherine.
Thank you. That's great. Thanks, Rosalie, and great to be here today. So in 2016 or 2015, when we were thinking about the fund, we really looked at where is Canada strong? Where is Canada leading? So that narrowed the bucket to areas where we had strong R&D, we had strong performance, and globally, Canada had a competitive edge. Secondly, we looked at what's fundamental, and health clearly fits that bucket. And then thirdly, sitting at Mars Discovery District at the time, we were sitting on Hospital Row. So there was a lot happening in the health research and right outside our front door, and leveraging the resources at Mars made health make sense. But really overarching, thinking about our fund themes, which are climate, health, and future of work. Health is not optional. It's really the foundation for anything else. You can't learn if you're not healthy. You can't really carbon capture if you're not healthy. So the opportunity for health is huge. Everyone cares about it. It's not optional. There's lots of, government cares that there's lots of stakeholder interest also for it. So government cares about it because a healthy society means higher taxes, more productive society, higher GDP, and individuals care about it. So you are always willing to spend money on your own health. And then obviously we saw a problem, right? So healthcare costs growing, patients not getting service when they need it, and not necessarily the right service at the right time. So we saw lots of challenges and friction. And so that really helped us easily choose health as an investment theme.
Thank you. What about you, Donna? What's your story?
Oh, well, I'll tell the fun story in that we were also looking at healthcare. We were initially incubated by Grand Challenges Canada, which is, I don't know how many people will know it, but it's an organization that's put out over $1 billion of often Canadian government money into international healthcare technologies as grants and loans. And we were talking to them about what could be done with equity instead of grants and loans. That's more sustainable capital to build large companies, sustainable companies. So we're targeting several problems. The first is women and children's health. Women and children often get missed. Most technologies done prior to the last decade were done mostly on men, well known that the science was mostly done on men. And children's technologies were just scaled down adult technologies, which were not appropriate. So we're looking at healthcare issues where women are, for women, where they're specifically addressed or where in conditions where women are disproportionately represented, like autoimmune disease, or that address where women present differently, like cardiovascular disease. So we're trying to reach women and children with better technologies. A lot hasn't been developed for women since the 1980s, but there are many new technologies now coming on stream that are more specific. We're also looking at global health. So often when you invest in the mainstream venture capital healthcare funds, they're very much focused on return, and we want it to focus on return and impact. And by that we mean we're looking for technologies that hit more people. You can get great returns investing in a therapeutic that targets a small population, and that is very necessary. But we want it to target broader population, and that includes women in other countries, not just in the US, but more broadly in emerging markets as well. And so we set up a fund that is looking for high returns, and we go alongside other venture capitalists that are also looking for these kinds of returns. We invest in companies mostly in high income markets like North America and Europe. But then we take these technologies to emerging markets as our impact. And we have a network of groups that we work alongside. And we now have somebody focused full time on achieving the impact. We're trying to show buyers too that when they buy the company, there is an opportunity within global markets and reaching a lot more people than just focusing in very narrowly.
Thank you, Donna. I'll get back to you too about the market, but wanted to hear from Michael also in opening remarks. Like, how did your organization got involved in this space of impact investing?
Yeah, thanks, Rosalie. So obviously, I'm approaching it from the other side, which is, starting with philanthropy, and we all know Terry Fox's story, and so since Terry ran in 1980, we've raised $1 billion that we've invested in cancer research, and when you look at what we've been investing in, it really is at that bench discovery side of things. All of our grants are awarded through peer review and competitions, and we're excited and proud of that. It moves into translation, and we kind of stop short of clinical trials, and we're moving in that direction. But what we also saw was that there are good ideas that are stuck in labs, and when ideas are getting out of labs, and our best entrepreneurs, we're seeing them go south of the border. And if they're successful in that competitive environment, what's happening is they scale south of the border, approvals happen south of the border, and then the impact coming back to affect Canadian patients is years behind, what it could be. And so from our perspective, we wanted to see if we could play a more significant role in seeing good science find the capital it needs to get out of a lab and produce ideas that are going to impact patients more quickly. And so for that, that's the Cancer Breakthrough Fund, which is the first cross-sector collaboration. So we're partnered with Lumira Ventures, and I can talk a little bit more about that as we get into the questions. But the reality is our motivation was we're focusing on patient impacts and improving survivor outcomes and improving treatment outcomes. And so we felt that we wanted to play more on the other side of the spectrum.
And so to all three of you, suspecting, Catherine and Donna, you have many years of experience, and Michael, I understand it's a journey that is starting. You have enough confidence in the market, the possibility to invest. There's like enough opportunity out there that will give you enough to chew on and have fun with, right? Can you expand a little bit on that?
Sure, I'm happy to jump in. So we've been operating now 10 years. We have 3 funds. Our latest fund, we're just investing now out of our latest fund. We're targeting 30 new investments across our sectors, but I'll say climate and health are probably taking up the majority of the portfolio mix. So we're looking at investing at approximately 15 healthcare companies, I'll say technology, software, AI focused companies over 3 years. So that's a lot of companies, largely in Canada. We do invest also in the US, up to 30% of the portfolio. We have made about 6 companies, 6 investments so far. So we're quite active and we have a significant pipeline. So we see approximately 4,000 deals a year. And of those, I'll say 1,500 or so are squarely in health, are in our bucket. And then we screen those to get to the final 5 to 6 investments that we make per year. So we're seeing tons of opportunity. And I'll say it's better, faster, cheaper to start a company today than it has ever been. We're seeing definitely more market pull, both from hospital systems who are saying, how do we treat our patients better? How do we clean up the systems mess from a technology and workflow basis, to clinicians themselves saying, I'm burned out. How do I spend more time with the patient, less time on paperwork, making sure I get them answers sooner? And then patients themselves and saying, you know what? I need to take matters into my own hands. I'm not willing to wait 6 months for a specialist appointment before I get some answers. So those are just kind of a pop-up of themes that we see that we get excited about investing in, but we are seeing no shortage of deals and entrepreneurs that are excited to tackle these problems, largely having suffered some version of the problems themselves. And I can talk about some of the results, but maybe Rosalie, I don't. I'll pass it to Donna and the others to talk about that, and then you can bring us back.
Yeah,
to
sure,
the
exactly.
results.
Donna, I was curious to hear about the results also. I was suspecting that you're going to say that the market has ample opportunities for investment as well.
Absolutely. So we're just having the first close of our second fund. Our first fund was a $90 million US fund, and we're hoping this one will be around 125 million. Yes, Catherine's congratulating. It's been a long road. Thank you. So we are really excited by the quality of investments that we're seeing. I agree with Catherine that we see the same kind of volume of deals. We're seeing a lot that have mature management teams. So these are not just early stage companies in terms of first time to market. These are ones where the serial entrepreneurs who are coming back to the market again to do something. So there's a lot of experience at the table. They've assembled very strong teams. And the market is really exciting for all the new technologies that can be done, advancements in sensors, AI. There's just so many diagnostics. There's so many things that really are disruptive, that are changing the game, with players that are either young team, a lot of women coming forward as CEOs, but surrounding themselves by people with experience, or, as I said, serial entrepreneurs. And sometimes we feel having an impact theme, we won't get the great companies. And yet we find a lot of enthusiasm when you are an impact investor, because employees really care about having a broader reach than just making somebody have great returns in a fund, and then that's the end of the technology. So when you can talk about a sustainable impact story, we very rarely have anybody who's not enthusiastic about what we're trying to do, including other investors. So we're really happy with the quality of the deals we're seeing right now and the volume.
Thank you. And so if I go to you, Michael, what kind of results are you expecting? What kind of, and, I'll ask you to expand also on if you can stretch it to financial results, because we heard you about the grants converting into investments.
Yeah, and so, just building on both Catherine and Donna, again, I'm excited about where the markets are at. There was a recent slide that we used that RBC put forward, and 9 of the 10 top exits in Canada were all in healthcare, right? And so healthcare has some tremendous opportunities. And over the last 5 years, we've been building what's called the Marathon of Hope Cancer Center Network, which is a collaboration across Canada to utilize data and technology to advance ideas. And so we have 55 hospitals and universities that now have created a shareable data lake using whole genomic sequencing, transcriptomic sequencing, and about 200 health data points. And that's going to create a tremendous amount of new ideas that these private sector and entrepreneurs can capitalize on when they understand the right targets and the right information. They're going to be using data to drive ideas. So I do think the next decade in healthcare is substantial opportunities. AI and advances in genomic science is really driving that. My expectations, we expect our fund to do 2-3x over a 10-year period. Like other venture, it's a closed fund. Again, I think that's realistic given that our partner has done that in each of their past 4 funds. So it's building upon their history. So I do think that you can combine an expectation for investment returns together with incredibly impactful outcomes that impact patients.
Okay. And what about your experience, Donna, and in terms of the results that you've been able to obtain over the years, including financial results?
So we've only had 1 exit in our first fund. Our close was December 2021, and we're investing just as companies are getting regulatory approval. So it takes a few years to get to market, start to build the proof to a buyer of what the technology can do. And so our first exit was a 2x exit, and it occurred 1 year into the investment. We're now at the point where we expect a couple of our companies will also have exits in the next year or 2, and then after that, that's kind of the time frame. So everybody says they'd love that 3-year time frame. I'm going to say it's more a 5-year time frame, especially with healthcare, because you really do need, if you're getting just at that commercialization point, you need to get into the market. You need to show adoption. You need the clinical evidence beyond the regulatory approval trials. You need further trials. And so this takes time, but you can then show buyers, and buyers are a little bit slower right now. So I'm expecting more towards 5 years as the exit, but we expect that 2 to 3x. I know everybody would love the 10x in venture capital, but I'd rather find really great companies that can deliver on that 2 to 3x than take the risk on 10x across the board. That's more a therapeutic play, and we do more diagnostic devices, digital health. Time to impact is too long with therapeutics, we found.
What about you, Catherine? Can you share a little bit and expand a little bit on the results and maybe start touching on a few examples to illustrate what impact could look like?
Yes, absolutely. So you mentioned I have 25/30 years. I like to keep it at 30. It makes me sound younger, but I'm just going to block it at that. So 30 years experience of investing, and I recognized coming from traditional, just private, for-profit, non-impact investing, you have to show a return, or this is just a charity, right? We're going after. We're talking to pension funds and family offices and foundations, and the critical piece of impact investing is that we have to return the capital. And if we are going to, if and in our case, we want to return venture returns, and so returning the capital is critical. And so we've been very active in making sure we are pushing our investments out the door. So I'll give you a couple examples. So our first one was 2016. That was the launch date. And we make investments over the first 4 years. Ink blot therapy, we invested in 2018. So online mental health support, obviously it's common today. This is not, revolutionary, but let me tell you, in 2018, it was pretty revolutionary. People were still going to visit therapists after school, after work, taking days off to take their kids. It was $200 an hour, and lucky if you had a match with that therapist. You felt good. They were same gender, same. They understood your particular area of need. So in Glot, we found significant friction. And we also found that corporations felt this pain point. Market ready buyer, individual patients were looking for something more seamless. So invested in Inkblot. 2.5 years later, it was purchased by Green Shield. So enter COVID 2019, online mental health grows exponentially, the need for that. Green Shield wanted to launch something of their own very quickly. Inkblot made sense to bring onto the platform. And so what we liked about this acquisition was that it really expanded the impact opportunity. So before Inkblot was acquired by Green Shield, it was serving in the 10,000 patients, 5 to 10,000 patients. Now Inkblot is serving, I think, up to 1 million patients, has served up to 1 million patients. So very significant scale and specific measured outcomes. So we really like that. Now on the financial side, we got a 4x multiple on this investment and a over 100% IRR. So we are looking to replicate that over and over. And in particular, Inkblot returned half the fund. So we made 10 bets in Fund 1, Inkblot returned half. The other half of the fund, of Fund 1, was returned by a company called Valence. Valence does computational drug discovery to develop the next generation of drugs. So creating the next generation of drugs, we want them lower toxicity, higher performance, and cheaper to design and develop, right? We all want that. Many companies are working on that. We invested in Valence in 2018 when we saw this opportunity. And frankly, the original thesis on Valence was to go after orphan drugs because they are notoriously underfunded. Probably many of you know that. And the thesis shifted, but the problem is quite large. And that company was acquired by Recursion, which is a US public company. And we did get a 10x on that investment. And we got a 10x on that investment combination of really managing our exit shares. So we got a combination of return on the acquisition, but then we had to hold some public equity shares. And given our team's background in public equity markets and relationships that we have, we were able to navigate that exit quite well. So we did get a 10x, and the return on Fund 1 is sitting at a 24% gross IRR and a 3.1x MOIC. So what Michael had talked about. So we're targeting that for Fund 2 and for Fund 3 as well. Fund 2, we've had our first exit, a company called Pathway Medical that was sold to US public company Doximity, which is a $4 billion digital health network covering 1 million clinicians, providing them tools for better diagnostics and better care. Pathway was a Montreal-based startup, and I'll say Inkblot was Toronto-based and Valence was Montreal-based, so all Canadian investments here. And Pathway, we got a 2x, 2x our money multiple of invested capital and a 27% IRR. And on this one, we're very happy with the MOIC, and it was a relatively quick, what we call DPI, return to our investors. And also the Pathway went from, I'll call it the thousands of clinicians to now reaching 1 million clinicians under Doximity. So super excited about that.
So lots of opportunities I can see. We're already starting getting some questions from the audience, so that's great. Keep sending them. Donna, I'd like to share one right away because what Catherine and you have been sharing makes me think about. So one of the question is, how involved do foundations need to be in those investment decisions? So Donna, can you explain to us maybe a little bit how it could work?
So in a fund like ours, you're investing in a blind pool fund. So we're making the investment decisions. Your decision is investing in our fund, and then we keep in touch on a regular basis, quarterly, provide a lot of information on the investments. Sometimes we have collaborated with investors if they're interested. For example, J&J Impact is an investor in our fund. We work with J&J quite a bit on due diligence or reaching out, for example, reaching out to people within J&J to say, what's the market like? How would you use this? Where have you seen competitors? We've worked with, there's a hospital foundation in the UK that's an investor. We've worked with them again on due diligence for certain products, but also we've talked to them about what would it take for adoption? Could we work with your hospital and for a trial? Every company that's commercializing needs to be working with the potential buyers. So if it's hospitals, you really do need to run trials that incorporate hospitals to give feedback on how it is used, what's workflow, what's really important about the product, how does it change things. So we've talked to this foundation about getting our product into trial. So it's more that kind of thing. If you were doing a different kind of investment vehicle, and we can talk about those kinds of options, then it would be different. But this is for this kind of thing, it's a blind pool.
A great Michael, you want to jump in?
Yeah, I do. I want to build on what Don's saying. And, this was a conscious decision for us. And from our perspective, it was really important that we didn't actually want to participate in making the decisions on which companies and why which companies. It's not our expertise. What we do in the fund and in our relationship with Lumira is we have great relationships with what they call key opinion leaders, which are top scientists across the country. And we're connected to different accelerator funds across the country. And so we have insights into what's happening, but we just move that information along to our fund investor and we let them do their job. And I think that's an important component of this kind of thinking, which is let's stay and do what we do best. And for us, that's allowed them to make those important decisions.
I was going to you next because one of the question from a participant is about the foundation. So how do foundations ensure that they have the expertise to navigate these investments? And more specifically, one of the participants is curious to know how your foundation approached this process.
Yeah, and so for us, we're calling it cross-sector collaboration, and it is new in Canada where foundation partners with a private sector venture fund the way we have, and again, we bring different skill sets to the table. Both the Cancer Breakthrough Fund, which will cap out at 50 million, and Health Fund 5 at Lumira, which is a $250 million fund, are linked. And importantly, that gives us economies of scale. So we have the entirety of a Lumira team now looking at about 1,000 deals a year in terms of what they're driving for those decisions. So again, our decision is to partner and make an investment and then participate in a way that allows them to really excel to do their job.
So would it be safe? Oh, sorry. Go ahead.
I was going to say there's also fund to funds available if a team doesn't feel that they have the inside skill to invest in one fund. There are impact fund to funds that are either focused on healthcare or specifically or more generally focused on impact. And there's in Canada, Rally does this kind of thing. They can do individual mandates or they can do a broader base mandate that's more diversification. Same thing in Europe and the US. There's a number of these organizations that can provide expertise and diversification if one fund, if an internal team doesn't feel comfortable in terms of choosing one fund.
So
And I
is it your
combine that with an investment committee, Rosalie. So I do have an
yeah?
investment committee that then monitors this from a governance perspective to make sure that, we're not that we're aligning consistently with the things that we want to achieve.
That's where I was going. I was going to ask, is it fair to say that a lot of it from a foundation's perspective happens at the governance level? So setting the investment structure, the investment policy, having, a view over each asset class and what each asset class you'd want to happen. Here we're sharing examples of venture, but impact investing is possible in other asset classes. So, as Jason was sharing at the beginning, one of the first step when you're an impact cruise is having that conversation at the governance committee level. So I'm curious to see, Michael, can you elaborate on, has this been hard? What kind of challenges have you overcome or experienced throughout this process?
I mean, it was a lengthy process, both, particularly at the governance level. So, I worked with my board of directors on the concept and the idea. We worked with our investment advisory committee. We had to address questions of conflicts of interest, of risk mitigations. Like all of those conversations are important conversations for a foundation to go through before they sort of jump into this kind of idea. But once we got there, we went with full empowerment to execute the partnership.
Great. And Donna and Catherine, I want to go over to you to say, what can you share? We can understand that it needs patience. What has been hard, unexpected, or what sort of challenges have you had to overcome?
I'll jump in. On the impact side, on the venture side, it's the same thing that every other venture capitalist faces when you've got changes in. This is a very interesting global dynamic. You've got AI that's changing a lot of things, so we're dealing with that like any other venture capitalist. But on the impact side, we initially thought that we would rely on donor organizations for capital for the emerging market work, and that has worked well. But the USAID unfolding presented a number of issues. It made donors really have to rethink their strategies because USAID was so much an important part of that. The other side is it takes a lot of work to do impact. We're trying to find sustainable partnerships in other countries to bring product in the same way you'd introduce the product in the US or in Canada. And that takes a lot of focus, and it takes local people to be involved in partnerships where people really care about it. And we've had to devote one full-time person. We actually have a person and a half now working on this. And before it was the deal people trying to do the same thing. And so I think that the level of effort required, it just means we need more people who have the actual impact experience in emerging markets. And so we're building that team out.
Catherine?
Yeah, I mean, I can echo Donna's comments. Impact measurement, tracking two bottom lines takes real work. It's worth it, but it's not free. Just given the timing, I'll just move on to, the opportunities for hospital foundations in this market. Donna touched on it, which is you're the customer for the hospitals are the customer for many of the products that we're investing in. And so you have so much value that is kind of untapped, right, for innovation. So it would be really sweet for, I'll call it, informal partnerships, or even, as a limited partner participating in a fund that invests in healthcare. You could really bring that value to not only improve innovations getting to market faster, but making sure the ones that really work in the hospital environment come to market and they actually work. So that piece, the due diligence support, when it's appropriate, just to Michael's point, like, let us do our jobs. We are the investment professionals, and so we're very good and experienced at picking, managing, supporting, exiting. But there is that due diligence piece that we obviously have existing relationships and networks to use, but one more doesn't hurt. To really understand clinical workflows, adoption barriers, decision making, conflicts, such that those investments, those opportunities get commercialized faster.
Michael, you wanted to jump in?
I do, and it's important. So for foundations, the CRA and the federal budget in 2000, I think it was 16 or 17, can't remember the exact year, opened the opportunity for foundations to invest in this type of a vehicle. But we're also limited in that our limited partnership cannot exceed 20% of the fund, or it's deemed like business. And so with a fund like ours, it is open to other foundations. We do have another national charity joining us as a limited partner, and any charity could join us. But if foundations are looking at this, they need to be wary of that 20% limitation on any one fund.
And I'll just add also, like, it's such a nice alignment, with the business of the idea of a hospital foundation to unlock some of this investment capital to really, make a difference for the hospital and the community. We didn't really talk about the climate piece here, which was in the opening, of decarbonizing the portfolio, but a lot really making not only decarbonizing your public equity portfolio, but thinking about how do you improve the portfolio to actually improve the planet through investments as well is an opportunity.
I'm sure we could continue on and on because this is fascinating. Thank you, all three of you, for sharing just a tiny bit of your expertise. I'm sure that we could learn a ton more. I'll just maybe spend, I know we've got 2 minutes left, just maybe in closing, wanted to share a little bit about the Healthy Capital program. So if we can go to the next slide, just reminding participants that it is a program for 2 years to help and empower hospital and healthcare foundation boards to integrate sustainable investing into financial strategy. We're well into that program as a partnership, as you can see, with the Canadian Green Healthcare Coalition, PEACH, the Trottier Family Foundations, the Canadian Climate Law Initiative, and Quinn and Partners. We're available and have led surveys, community of practice, various education sessions, and we are about to launch tools that have been co-created. So you're going to learn it here in advance of everybody else. The tools are going to be launched tomorrow, and so we'll let you know where to get them and the website. So hopefully, if you're interested in learning more about sustainability and impact investing being one of the area, I know you saw Jason with the spectrum, one of the various possibilities of aligning further the capital that you're entrusted with the organization's mission. So we hope this was informative. If you've got any questions, we'll share in the notes any contact information. We're welcoming any questions, but also any requests for support. We've got a ton of material available. So thank you again and have a good day.